Welcome to Unit 5 of the Audit module. In this topic, we'll be talking about materiality, audit strategy, and audit plan. So first of all, materiality. So materiality is a really important concept within audit. And it basically talks about how big of an issue does something have to be before we do something about it. That's not the technical definition, but that's the simplistic way that I think about it. So as I mentioned before, and as I keep mentioning every single chapter, audit's about identifying as much or minimizing the risk of material misstatement with the resources that are available. So it's about making audits as efficient as possible. It's about allocating risk according to where the biggest potential risk is. And part of that is identifying the largest dollar value. So within audit, sometimes you'll have a variance or an issue that might be $1, might be $100, might be $1,000, $100,000, $1 million, $10 million, $1 billion. You know, for a company like Apple, with a market capitalization of $1 trillion, if it's got $1 billion, or I should say, if it's got $1 million variance, that might be immaterial for that particular company because it's so large. And they say, don't worry about it. If it's 99.99% correct, don't worry about the $1 million difference. Whereas if you're dealing with a company that has a 10 million market capitalization, a $1 million variance would be a huge impact on the company because that's 10% of its market cap. So it's all about putting it into perspective as to how big the issue or the variance or the variance is. So the technical definition of what materiality is it's any difference between the actual amounts, classification, presentation, or disclosure of reported FinStat line item, classification, presentation of and disclosure that is required for the item to be in accordance with the applicable financial reporting framework. So it's a much broader definition to what I said. So first thing is it could be about amounts, it could be about classifications, it could be presentation, or it could be disclosure. So anything that is different from what it should be, that's a variance, okay? And then you compare that against that's the definition of misstatement. Materiality is the level, right? Is what I said, the level of risk that is okay, or what the auditor is saying that we should focus their attention on, so that it becomes an issue. So the technical definition of materiality is appropriately enables the auditor to focus their attention and effort on the high risk areas of the entity's financial statements. So generally what happens is in the risk assessment process, so from chapter 3 down here, we'll sit down with the team and they'll go through, these are all the risks. They'll identify if it's a high-risk client or a low-risk client and where there's risk areas, and then they'll set the materiality threshold for the business. So taking all of those things into account. So it might be $1 million, it might be $10 million, it might be $1 billion, it really depends on the company. So materiality throughout the audit process. So an auditor is required to apply the concept of materiality throughout the audit process. In planning the audit, in performing the audit, in evaluating the effect of identified misstatements on the audit, evaluating the effect of uncorrected misstatements on the financial statements, and forming the audit opinion. So all of these things need to be viewed through the lens of, is this material? If you add up all the variances and it's $1, well, yes, there's a variance, but it's an acceptable variance. It's not material. If it's $1 billion variance, after you've added everything up, then that is a material difference. And that's going to form into all of those things. So, for example, in the audit opinion, you know that those variances exist, but those variances might not impact the user of the financial statement's understanding of the business. So in that case, it's not actually going to have a negative impact on the audit opinion at all. So that's kind of how it affects each of those stages. Okay, so ISA 320 provides guidance on how auditors apply the concept of materiality. And there's kind of 3 sections, right? So there's risk assessment. So that's determining the materiality for the whole financial statements as a whole, and performance materiality, and planning what risk assessment procedures to perform. The risk response to those assessments is determining the nature, timing, and extent of further audit procedures, revisions to materiality as a result of change in circumstances during the audit, and then reporting is evaluating the effect of uncorrected misstatements and the opinion of the auditor's financial report. So levels of materiality. So the auditors use professional judgment to determine the misstatements that will be considered material. ISA 320 describes 4 materiality levels: overall, performance specific, and specific performance materiality. Okay, so each of these are different concepts because you kind of have a materiality for different levels within the business and within the financial statements, right? So for example, one would be overall across the whole business. Once you've added up everything, is it material? Or it could be for a specific account, like let's go into, inventory or cash and things like that. And you might have a variance in that account. So that account might be materially misstated, but the financial statements as a whole might not be materially misstated. So that's why there's different levels of materiality. So we've got this flow chart here from ISA 320. So number one is at the financial statement level. So it's the easy to understand, so across the whole financial statements. And number two is for a more specific, so it's for a set of class of transactions, account balance, and disclosure level. So you can have something which is materially misstating the more detailed side of it without impacting the overall materiality, but it's difficult for it to impact the overall materiality but not the detailed level. So the definition of overall materiality is materiality for the whole financial statements as a whole with reference to the needs of users of financial statements. And then the performance materiality of that, which is like a subsection of that, is based on the overall materiality but set at a lower amount. This is to reduce the probability that uncorrected and undetected misstatements exceed overall materiality. When the audit procedure is done, because there's interim periods close to period end or after period end, and there's the extent, so the number of items you're going to do, the number of audit procedures to be performed, evidence that you've specified the information used, and documentation. So you must be documented so that someone else can also be able to perform the procedure. Okay, so the initial risk assessment, as we know, is completed at the beginning of stage of the audit before most audit procedures are done. However, the risk assessment is also a continuous activity throughout the audit, and the auditor may uncover identified risks or information that may cause them to reassess the risks and change that audit plan. And of course, that plan should be amended appropriately depending on the risk. For example, the number of errors when testing controls may be higher than expected, which may increase the risk. While intending a stock take, the auditor may discover material obsolete inventory that management had not identified. And of course, this would increase the risk. And the company is going to change its plan, its approach to each of these risks. So for example, for the inventory potentially being obsolete, the auditor may increase the assessment of risk, as we mentioned, and perform additional audit procedures in respect to inventory carrying values. The auditor may discover material liabilities that have not been recorded due to weakness in management's process for identifying accrued expenses. So the auditor would increase the risk around unrecorded liabilities, and then they'd usually plan additional audit procedures designed to address the weakness identified. So that's generally the approach: is if there's a new risk issue, address the plan to show more risk in that category, and then do more testing. And what kind of testing you do? Is it substantive? Is it controls? It depends on what you found. So that's the end of Chapter 5, Materiality. Next, we'll go into each of the different types of testing control, and then substantive testing.